Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here. Got a very special returning guest, John Luke Tyner, the head of fixed income at Aptus Capital Advisors. John, Luke, how are you doing?
What's up, Josh? Happy to be here.
Thanks for coming on late notice.
Of course.
It's good
Got
stuff.
a rainy day.
Yes, we do. Yes, our rainy day, but we're cozy here inside Coastal College's recording studio, beautiful downtown Fairhope, ready to put together another great show for those of you tuning in. Listeners, John Luke and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on the topic of the day. Second segment, we've got headlines of the week. And then roughly 50 minutes-ish past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. Either way, buckle up. We got a lot to get to. Now, quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We got offices in downtown Fairhope. We got an office in Orange Beach. We got a third office in Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website. That's gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, don't worry. Grab a pen, grab a pad. We're going to repeat it several times throughout the show. John Luke, for newer listeners that haven't heard of you before, and before we get started, would you mind describe your role at Aptus Capital Advisors?
Yeah, perfect. Yeah, so I head our fixed income research and trading within our portfolios. And so when it comes to, building fixed income solutions for clients, I focus a lot on that and, municipal bonds, income components for folks' retirement, especially folks in retirement that need, current income monthly, annually, et cetera. And then I also focus on the options deployment within our ETF strategies. And so we use options for both income enhancement as well as risk mitigation. And so a key focus is a lot of math, really.
It's a ton of math. What's your degree in?
Accounting.
Accounting, okay. So it kind of fits, right?
It fits.
Yeah, I have an economics degree, which I think kind of fits.
Oh, yeah.
And the funny thing is, looking back, not to get on a segue here, but when I came out, I loved economics, which is a weird thing to say. And I don't know why I didn't choose it as a career path right off the bat. I have no idea, right? So I kind of circle back in a long ways. And maybe you feel that way with accounting, right?
Yeah, I love economics too. The hard part on economics and the key difference between accounting is there's really no answers. There's history that you can rely on, and history tends to repeat itself. But with accounting, you balance the ledger, right?
Yes. In economics, it's always, it depends, right?
Depends.
In accounting, it's got to be, what is the number?
Exactly.
Well, very good. Now, listeners, quick disclaimer, especially for any of you regulators listening in. Aptus Capital Advisors, to describe the functions between our two firms and my firm, Gulf Coast Financial Advisors, they serve in what's termed a sub-advisor role. That means that Aptus helps our team at Gulf Coast with our clients' investment accounts, portfolio construction, trading. There's many services they provide, and you just heard John Luke talk a little bit about his piece of it. What it does not mean is that John Luke Tyner or Aptus is employed directly by or for Gulf Coast Financial Advisors. John Luke's advisory services are offered through Aptus Capital Advisors. That is a registered investment advisor, registered with the Securities and Exchange Commission, and based in Fairhope, Alabama. And finally, Aptus Capital Advisors and Gulf Coast Financial Advisors are not affiliated. All right, let's get on with the show. So, John Luke, I don't know if you pay attention to the news or not.
Yep.
A little bit. Do you do like I do you watch cable news?
No.
Good. All right. Well, there's been a lot of talk in the news about the stock market being in an artificial intelligence, an AI bubble. And if you look at the numbers, it can be a little disconcerting. Price to earnings ratios are super high, at least historically. There's been a wave of corporate mass layoffs. I can't remember the latest one. It was either FedEx or UPS or something like that. There's been inflation is proven to be sticky. And in particular with AI, we have a handful of companies betting billions and billions of dollars when there's not a 100% clear path on how they're going to make money on AI at the end, on the other side of all these massive bets. And these just happen to be the same companies that are the primary engine behind most of the stock market gains this past year. So it can feel a little precarious. But with all that concerning news floating around, when I asked you what you wanted to talk about today on the show, you landed on discussing the case for investors to remain bullish, not bearish, bullish heading into 2026. Why is that?
Yeah, there's many things. There was notable short reports from Mike Burry, who is notable for his call
the
of
Big Short,
Big Short, right, with the financial crisis, and basically poked a pen in the housing crisis that created the great financial crisis.
Yeah, Christian Bale played his character. One of my favorite books, one of my favorite movies. We'll discuss more of that later.
Yes.
But yeah, he was shorting a lot of stuff.
Yeah. Yep. Several of the big Mag 7 names and a few others that were tied into kind of the theme. And really, I think there's different ways to dissect it, just like any market. There's going to be some massive winners from the AI build-out, and I think the profitability will kind of work its way through with some of these top companies, and there's going to be some duds for sure. But when you look at, quote-unquote bubbles, and Brad Rapking, who's one of my colleagues, made a great comment about it doesn't, the call for us being in a bubble seems like there's a bubble in those calls being made instead of actual a bubble in markets, because everywhere you turn, people are talking about it. And, I think that's just how we're geared as investors. Is we're trained, and we saw this in our schooling, as you can probably allude to, Josh, where there's boom cycles and there's bust cycles. But keep in mind, we haven't seen a recession since 2009.
Well, so let's talk about that. In a normal capital society, the market, at least what we were trained historically, if you will, the market's supposed to run up, it's supposed to boom, then there's supposed to be a resetting, a market sell-off or a correction or a recession. Every so often, there might even dip into a little bit of a depression. But even as rocky as the market has felt since 2009, so well over 16 years, what you're saying is technically there has actually not been a true recession.
Correct.
Right? And what do you think that is?
Well, I think that there's a lot more involvement from the government, for one, with the Fed and how they cut interest rates and how they expand their balance sheet, which we'll talk a little bit about that in kind of my case looking ahead. But additionally, the scope of the economy has changed drastically. We were in a farming, agricultural, and manufacturing economy for a long time. And those are highly cyclical and weather dependent and all those type of scenarios that create the backdrop for it. And with that, you see some boom and bust. Now our economy is based predominantly on services and technology, which are much less cyclical in terms of how they play out. And that's been backed with years and years, especially since the financial crisis, where the price of risk assets, the wealth effect, has really played into that hand very well, because as consumers have money, then they spend it on more services. They go on more vacations, they do things at their house, they go out to eat, etc. And so as the economy has shifted to more of a service and technological innovation-based economy, it's created a smoother pathway, I think, for economic growth and just less choppiness that maybe you saw when the landscape of the economy was much different. Well,
and I know we've got a punch list of things that we want to talk about that are kind of key points in supporting your view not your view, but the reasons for being bullish in 2026. But before I get to that, in a meta sense, or in a bigger sense, if you will, is one key difference with what we've had going on with this quote-unquote bubble is the amount. So let me back up. Would we all agree that a lot of the stock market gains that we're seeing are driven by the billions and billions of dollars being spent by certain companies in AI investment, correct?
Yes.
Yeah, Google, Meta, Amazon. I mean, you could go down the list, right?
With the caveat that these companies are making a buku of money.
Which leads me to the second point. Historically, a lot of bubbles were debt-driven, right?
Correct.
I mean, 2008 is a primary example. Now, of course, that was mortgage financing shenanigans, but at the end of the day, the debt house of cards is what fell.
Yes. The buck came due.
My understanding in this particular investment spree, outside of Oracle, none of those main AI companies are dramatically increasing their debt balance sheet. Is that fairly accurate?
Yes.
Okay.
And if you look at their debt ratios versus, the average S&P 500 company, it's laughably low. And so there's still a lot of room for these companies to very responsibly expand their borrowing in a smart way. And remember, if they can borrow at much lower rates than you or I could go to a bank
Right.
and borrow, they have an advantage. And if they can create growth that's greater than the rate that they're borrowing money at, which really hasn't even turned on yet, I think you could see a lot more borrowing from these companies to get to debt ratios that would be difficult for them to support. We're nowhere close to that fact playing out.
Right.
But if they invest in this technology and it ends up being a big generator of revenue and of earnings, then it's a great bet for them and could really continue to propel the market higher. And you've heard comments from many of these companies where they think the risk of not investing is greater than the risk of taking a shot and investing, which really goes down to the confines of defining the type of bubble. If you have a bubble that's suited in innovation and growth and technology and innovation, then those type of things tend to benefit society at large. The bubbles that are scary are the ones that are debt-fueled, like you mentioned,
Right.
but also commodity-centric.
Okay.
So think like the tulip bubble back in the Netherlands in the
Right.
late
The Dutch.
1600s, right?
Yes.
Like that was a worthless bubble, right? Those tulips could do absolutely nothing for you. But think about what we got out of the dot-com bubble, which, of course, was a bubble in technology and the internet and all things sort of surrounding that. But what did we get out of it? Well, you got millions of miles of fiber put in the ground that improved the connection and ability for us to have to communicate with people all over the world. Shortly after the dot-com bubble, you got Facebook, which maybe isn't a great thing for society, but
Right. There's argument to be made there.
But it's still driven
It's
a
driven
whole
economic
new
engine.
a whole new segment of markets, and that's what we tend to see over time is that capitalism, that growth drives new industries, and I think that's what we'll continue to see out of this AI backdrop. But not only did you get Meta, you got the iPhone, you got Google Search.
Amazon.
You got Amazon.
Right.
You got the build out of Microsoft and the crazy things that they have in addition to just Microsoft Office, which was the start of kind of their business. But it really has led to great things. And so while speculators lost money during that, ultimately society was better off. And so I think that's just why it's really important and prudent to be smart with how you sort of chase this investment theme we're seeing.
Yeah, I'd forgotten this, but at one point, Amazon had lost 90% of its market capitalization during the downturn. That's crazy.
Yeah.
Now, if you just bought then, hey, you'd be doing okay.
Yep.
Well, all right, so let's use that as a springboard then. So we talked about some broad economic trends around the case for being bullish versus bearish as we're moving into 2026. And, a couple things, I guess you call them disclaimers, if you will, John Luke. We don't know. I mean, we could be wrong. The market could correct by the end of the year pretty dramatically. So there is certain levels of investing that not everybody is comfortable with. So anyone that's listening to this, we're not telling you just to blindly invest and expect everything to go up. This is not, money number go up guarantee type of stuff. But what you see over time, we're going to lay out some of the fundamental things that may be supportive of a bullish market in 2026. And quite honestly, if you take a bigger step back from the whole argument, if you look at the history of the stock market, as good as it feels to be right sometimes when you're being bearish and making bearish predictions, the honest answer is bulls outperform bears over the 100-year history by a factor of X times money, right?
Yes.
I can't remember the saying. Maybe you know off the top of your head. If you don't, I don't mean to put you on the spot, but bulls create wealth, bears create articles or something like that. I don't remember how that saying goes, but it's better for the long run to have a more optimistic view if you're looking at investments. Now, there's going to be
bears sound smart, bulls make money.
There you go. Thank you. I knew you had it. Yes, that's perfect. So we're going to talk about some of the reasons why we're bullish for 2026. And I'm going to tee this up, John Luke, and then let's talk about each. We got about 10 minutes in this segment. First, and this is all over the news as well, a reason to potentially look bearish in 2026 around the stock market is the Fed is back into interest rate cutting cycle.
Bullish.
Okay, let's do it. Yeah.
Yeah. So
I said bearish. Excuse me. For bullish in 2026. Pardon.
Yes.
The Fed is back into
a rate cutting cycle.
All right.
So the Fed has cut rates so far since September of 2024, 150 basis points, and another 25 basis point cut next week on the 10th looks almost like a guarantee.
Now, 150 basis points for the regular person means 1.5%
Yes.
in the Fed funds rate.
So
Okay.
rates went from 0 to 5.5% off of COVID and with all of the inflation backdrop. And they raised rates to slow down the economy, to bring back inflation into check. And then you lower rates because you want to support the economy or get back to a neutral interest rate, which is kind of where things are more normalized. But ultimately, as the Fed reduces their interest rate, the policy rate, you inject an ability for consumers, for businesses to access debt or to finance debt at cheaper rates, which leaves them more discretionary money to spend on other things, as well as it maybe makes projects that didn't make sense at 7%, prime rate that do make sense at a 4% or 5% rate. And so what we're trying to see here is an ultimate balancing of the economy from a rate perspective. And keep in mind that small businesses employ or create about 50% of the jobs in the country.
Okay.
And small businesses are highly dependent on bank financing, on credit cards, on shorter duration, shorter term borrowing. And so as interest rates move lower, it immediately impacts those portions of the economy, which make a big difference in our overall GDP.
Well, the Fed has two primary jobs: to watch out for the jobs market, right, and to tame inflation. So I think that there's been at least somewhat of a understanding that we may never get back to the quote-unquote Goldilocks inflation number of 2%, which who knows who made that up, right? But
New Zealand.
Okay, thank you, New Zealand. That tracks. And then, but what we have definitively seen is definitely some pressure on the job market.
Yes.
And so the Fed is, I know the Fed sometimes gets a bad rap, especially in the last year or two, but not to defend the Fed, but generally speaking, they're run by grown-ups. And so they're going to look at the data, and they're supposed to act non-politically. And when there's pressure on the jobs market, they have to make a choice between inflation and jobs. And right now, at least when they state something publicly, generally speaking, they don't do any type of knee-jerk reaction back the other way. So they've expressed to us, hey, we're not going to tell you what the cut is, but we are definitely back in a rate-cutting cycle. Is that accurate?
Yes.
Okay.
Which is just broadly accommodative for markets in the economy.
Very good. So again, a reason to be bullish. Then, speaking of the Fed, now we're going to talk more about this in an article, so let's just lightly touch on it. But the Fed balance sheet stopped declining in December, in fact, just a few days ago. What does that mean? And then listeners, stay tuned for segment 2, because we're going to dive more into the Fed balance sheet and why that matters so much to investing in the economy. But real quick on that, John Luke, why is that important?
Yeah, so the Fed balance sheet is basically a mechanism that the Fed can utilize to impact markets and impact interest rates. And this became more popular after the financial crisis. The Fed's balance sheet rose dramatically after COVID, as we were trying to avoid going into something really deep and dark.
When we send all that stimulus out, that
Right.
goes down as a liability on the Fed's balance sheet.
Correct.
Right.
Yes. And so what you've seen as the Fed was tightening financial conditions, raising interest rates, they also were letting their bonds roll off of the balance sheet. The balance sheet was reducing in size. And what you've seen is they've actually just stopped that earlier this week, where the balance sheet's no longer going to decline, and it's actually probably going to increase. So it might not be quantitative easing or QE in the sense of like really backing and supporting markets, but it's certainly accommodative to the backdrop. And how I think about it is basically the Fed's balance sheet should grow in line with the growth in money supply over time.
Okay, very good. It provides some stability that people were looking for.
Yes.
Right, okay. All right, here, moving down the list, we've got the one big, beautiful bill. So a reason to be bullish in 2026. There's some things in this bill that will be stimulate consumer spending in 2026? What are some of those things?
Yeah, so the main part for the consumer is with no tax on tips, Social Security, and overtime,
Yep.
that essentially there will be a massive tax refund to a lot of consumers to the tune of about $150 billion in 2026.
Now, will folks see that in real time, or will they see that when they file their 2020? I know, well, you got your accounting degree. When they file 2025 taxes, when will that be realized? When will they see that?
Yeah, so when they file their taxes.
So
because
we'll see that in real time.
The
Okay.
money from the bill was basically, they over collected taxes for 2025
Okay.
because the policy got implemented mid-year.
Understood.
And so then the money will come back, which probably incentivizes people to do their taxes quicker.
Yeah, this is true. Right, which hopefully will have a increase of flow money in, because we're going to talk more about this later, but it's wonderful that people get tax refunds, but there's still a federal deficit that's concerning. We're going to argue both sides of that later. Stay tuned in this episode. Other things in the One Big Beautiful Bill, it's also looking to stimulate corporate investment.
Yes.
How does that work?
Yeah, so basically when companies make investments to reshore, to remanufacture things in the U.S. and make investments in property, plant, equipment, that there's accelerated depreciation that happens. So it's essentially a big incentive for the company to make those investments. And you're seeing that not only happen in kind of the manufacturing backdrop of the economy, but also with the AI CapEx, the capital expenditure that's going into the AI frenzy that we're seeing, where companies are being incentivized heavily to invest for the future.
So you just mentioned a term that, it's funny, we have these terms now that we just use all the time that, in my opinion, barely existed a handful of years ago. One of those is CapEx. So for regular listeners that have heard all this CapEx, AI CapEx, Google's got so much CapEx, that means that they're a good bet, blah, blah, blah. Explain CapEx for us and how that actually fundamentally works.
I think the simplest way is it's just an investment in future growth for the company. And so they're building things out that they think will turn into sales and earnings in the future.
Well, and to put it in some terms that I think regular investors will understand, when a publicly listed corporation, publicly traded corporation has profits, has excess cash flow, they can choose to do a couple different things with that cash flow. Some of them can choose to just sit on it. Some of them can choose to buy back their own stock. That's what Oracle did for years. But what they're choosing right now in mass is they're choosing to take that excess cash flow and those profits and invest in the future. That's generally speaking a good sign for the stock market, right?
Yes, and economy, and jobs,
right,
and really everything.
Because if the corporation at an entity level was worried about investing in the future, they would be sitting on cash. They'd be buying back stock as opposed to investing in CapEx.
Yep.
Makes sense?
And part of it, too, that's probably maybe underlooked is the 21% corporate tax rate and the impacts of that on the economy, where companies have more money that they have a decision to make with because they're paying less in taxes. And so I think a rightful way to think about it is they invest in the future, which invest in jobs and people, and hopefully earnings for the economy, earnings for the S&P 500 and stock markets at large, which keeps things ginning.
Man, we got so many things we could talk about. You got to come back, all right? Because there's so much meat on the bone here. But for this segment, we're going to start wrapping it up. That's all very good stuff. So listeners, if you've liked what you've heard and you want to set up a follow-up conversation with the team at Gulf Coast Financial Advisors, it's easy. You can give us a call at 251-327-2124. A live human being answers that, typically me. Or you can find us on the website. That's gulfcoastfa.com. The FA stands for financialadvisor.com. Now, when you're on the site, there's a blue button in the upper right-hand corner. You can click that. It'll put a meeting on my calendar. That meeting can be as simple as a 15-minute phone call. It could be a 30-minute Zoom for those of you all that are busy and prefer to meet via Zoom. Or, my preference, it can put an in-person meeting at any of our 3 office locations. Again, that's downtown Fairhope. That's Orange Beach, just down the road from the wharf off Canal. Or we're in Mobile. We're near the intersection of Dolphin Street and I-65. However you reach out to us, make sure you do. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. And then we're going to give you our honest opinion about these headlines. So join us after the break to hear John Luke and I discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Knoll, here alongside guest co-host John Luke Tyner of Aptus Capital Advisors. So as we discussed before the break, every week we scour the World Wide Web for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read these referenced articles yourself, we do include the links in our show transcript, which will be posted on our website, gulfcoastfa.com. Just look under the podcast tab, find the episode that you want to hear again, and look for the transcript, and you can find the article links. With all that said, and without further ado, let's get at it with Headlines of the Week. So normally, John Luke, as you remember, Michelle reads this part and I react, but this time I'm going to play Michelle's part, okay? And what I wanted to do is, instead of starting out with a headline for our first article, I wanted to start off with a book recommendation. So a couple episodes back, I gave listeners my top 3 or 4 financial books. I'll give you a quick synopsis. I think, in my opinion, I'm curious to yours, but I think everyone should read at least once Dave Ramsey's Total Money Makeover. I don't know if you've ever read that or not. It's a good one. It's a good one for a lot of people. And then I had a couple books listed for a fun read. I did, of course, these, one would argue that they give a glimpse behind the scenes of our business, but I think you would argue that they are a little exaggeration thrown in. I'm referring to Liar's Poker and The Big Short. We mentioned that a minute ago. That's by author Michael Lewis. Those are fun, right?
Yeah, great books with good historical context,
right?
That but add some fiction elements to make it entertaining.
Well, not to get off on a tangent, but Liar's Poker is about the bond market. In fact, it's really
Solomon Brothers.
It's really when the bond market became sexy, right, in the investing world. Did that make you want to get into fixed income and bonds? Did it have anything to do with it?
Yeah, it was one of the books I read in college.
Yes. All right, I feel good. I also told everybody, don't waste your time and never, ever, ever, ever read Poor Dad, Rich Dad. I don't know if you read that one.
I have, and it's a crappy book.
Well, the problem is it's an excellent book. It convinces you that you should basically just leverage your entire life to the hilt and invest in fixed assets. And that's a system that works until it doesn't. It's by a guy named Robert Kiyosaki. And I paid attention to that book, much to my financial detriment. And, to his financial detriment, he's being sued by every person under the sun at this point. But so anyway, long-winded way of saying I asked you for your pick. And true to form, you went a little inside baseball with a book called, I'm going to turn it over to you. What's a book that you think our listeners should try to find and pick up and read? Give us the name of it, the author, and tell us a little bit about why you love this book so much.
Yeah, so the book I chose, which was a pretty easy one when Josh asked the question, is The Price of Time by Ed Chancellor, who is, I think he's from the UK, but he's a historian and kind of an academic guy. He comes on some podcasts for nerds like myself that love history and specifically financial history. And the book is all about the price of time, which is essentially interest rates and their impact on economies, on civilization, on history. And really, he's making the case that we need a prudent level of interest rates where there's a good mix of supply and demand between money that people can borrow and how it gets allocated. And that if interest rates are held too low for too long, that it creates sort of maluse or malfeasance within the industry of borrowing. And so that kind of tees up the private credit discussion that we briefly talked about.
Yeah, we're going to circle back to for sure. Yeah. It's
a great book, and it gives a good history. It goes back to like Babylonian times and talks about interest rates
does
back
it really?
then.
Okay. All right. So I'm a history nerd too. I went to read this book.
COVID, essentially. I think it was published in 2021.
Okay, which would have been a good time because we had what I think most people would agree were artificially held low rates. Do you agree with that?
Oh, yeah.
And I don't know how you feel about it. Some of the times I don't mean to put you on the spot because I have my opinions on things. Doesn't mean it's your opinion too. But a lot of times it leads to nonsense like SPACs. SPACs are what? Special
Purpose Acquisition Companies.
Right, which basically was, hey, I'm going to give this group, a lot of times it was led by kind of a singular investment manager. I'm going to give this person billions and billions and billions of dollars to go do, or millions of dollars to go do something, but I'm not sure what they're going to do. And I don't know what the failure rate on SPACs would be, but I know it's pretty high.
Yeah.
Right? And so back to your point, when he wrote this book, we were coming out of a time period of low interest rates. Then we slammed right into COVID and slammed right into all this stimulus. Well, what was going to be the natural result?
A lot of misallocation of capital.
And crazy inflation.
And if you think back to, it was pretty timely because 2022 was the downfall for a lot of those companies.
Yes.
And that was right after he put out the book.
Yeah, we don't pick the scab of the investors that were heavy in the market in 2022, but the market down overall was down somewhere in the 20-ish, 25% range, right?
At the lows.
At the
lows,
right.
It finished about 18.5.
It rebounded some, but more disconcerting was the fact that the bond market overall was down what?
Was down about 15%.
And there were some segments of it that were down.
Long duration got absolutely smoked, and then any highly speculative, non-earning type of company that screamed out of COVID absolutely collapsed. Like a lot of I think ARC, Kathy Wood's fund, was down like 70 or 80%.
Just trash, right? Yeah. So the cleansing happened in the bond market. It affected the overall bond market, which was troublesome because a lot of retirees held bonds as their safe investments, right?
Yeah.
And they're looking at their bonds, and of course you can hold them duration and get out of this thing alive. But if you're needing to have a liquidity event and you're looking at a bond that's 15-20% underwater, you're like, what the heck? This is not what I was told was going to happen, right?
Yeah.
But we're going to talk more about ways to get around some of that. Even though you're in fixed income, you hold a contrarian view that we're going to dive in a little deeper.
Cool.
All right, so the book again was called
The Price of Time.
The Price of Time by Edward Chancellor. I like that. All right, pick that book up, folks, and also pick up Dave Ramsey's book, The Total Money Makeover. And if you have Rich Dad Poor Dad, burn it. All right, number 2. All right, listeners. So some advice I got years ago about having a radio show was to, quote, make sure there's some cookies left on the first shelf, unquote. Meaning, if you're constantly in economic nerdville, you will lose some of your listeners. And that's true. But this article that we got coming up is probably closer to the top shelf, so I'm just warning you listeners ahead of time. But it is, for you savvy investors, this is definitely worth the lift. And it also helps John Luke and I expand on something we discussed in the opening segment. There's a very recent article titled Fed Ends Balance Sheet Normalization, and that is on a site called cfcsolutions.com. Have you heard of that site?
No, I don't
It's
think
got to be
so.
certified financial something, related to a lot of the you have your CFA certification, correct?
Correct.
Certified Financial Analyst. Anyway, back to the point. The article states that on December 1st of this year, just a few days ago, the Federal Reserve officially halted its quantitative tightening program, QT. That's the process of letting the bonds mature without replacement. This decision came sooner than many expected and was influenced by recent volatility and increasing pressure in money markets, which I find that fascinating. I want to talk more about that. By ending the decline, the Fed removes a major headwind on market liquidity, aiming to stabilize short-term funding rates and restore a sense of, quote-unquote, ample reserves in the banking system, which apparently had been being quickly depleted, which I'm embarrassed to say I didn't know that. But here's my question, John Luke. Since the Fed has effectively stabilized its balance sheet at or around $6.6 trillion, what does that tell us about the Fed's primary focus right now? Is it still inflation? Is it liquidity stress? Is it fear of a recession? Is it jobs? What's it focused on, and why does this matter?
Yeah, so when you mentioned the Fed's objectives earlier, I think there is a third one that involves liquidity and making sure that liquidity is prevalent in markets. And what ultimately that the balance sheet has led to has given them another tool in their quintessential toolbox to dictate and impact markets to some degree. And so I think that the balance sheet reduction was certainly needed after COVID because we really overspurred things. And
what pump? We pumped how many trillion into the economy?
Well, as far as the Fed's balance sheet goes, it went from like 4.5 or 5 trillion to like almost 9 trillion. Very quickly.
Right, which is why your dingling neighbor had a brand new Corvette in his driveway. There was just too much thrown out there.
And it impacted the housing market because the Fed was buying mortgage-backed securities and kept rates low. Like you could teach a full semester academic class on the Fed's balance sheet, which is why it's a big question. But I think the way to simplify it as best as possible is the Fed has totally pivoted from worrying about inflation and just sort of been okay with the fact that we're probably not going back to 2.
We just ain't going to lick it right now.
3% is the new 2%.
Right.
And they're worried.
I like that. We got to coin that.
They're worried about the labor market, and they don't want to see any more deterioration. Unemployment rate went up from, I think at the lows it was like 3.5, maybe 3.4%, and now it's 4.4%. So that has, it's not high historically, but it's gone up, a decent chunk from the lows. And then the liquidity concerns, like you mentioned, certainly create some additional noise that us regular folk don't see, but behind the scenes, liquidity dictates pretty much everything, having the ability to transact at a reasonable level. And so as a market participant, specifically in the fixed income space, you could see some things happening the last month as rates dislocated a little bit. Mm-hmm. And so it's really just the Fed is coming in and probably working to a degree with Scott Bessent at the Treasury.
The current administration.
Right. There's some back and forth there.
Absolutely.
More than what people probably want. And I think this happens all the time, not just this administration.
Right.
But what they're doing is making sure the liquidity stays ample.
Well, correct me if I'm wrong, but the 2008 crash obviously was related to the housing market and the mortgage industry, but really at its root, it was a liquidity crisis. You had so many billions of losses hitting the system all at one time that there was not enough liquidity around to address the problem. Is that what you think?
Well, there was some bad assets.
Right.
So
on top
today,
of bad assets.
Today the difference is there isn't necessarily bad assets, and I don't even know if necessarily is the right word. It's more liquidity concerned as far as keeping things ginning. And so, like the adage that I've always followed through is if it's a self-inflicted market downturn based on liquidity, based on Trump saying something, or whatever it might be, if it's self-induced, it's typically a great, or a political-driven, election-driven, it's typically a great opportunity to put money to work.
Understood.
If it's cyclical and there's debt, there's bad assets associated with it, then that can be, temporarily pretty bad.
Yes. Yeah. And to wrap up that article, you said that, the 3% is the new 2%. I'm totally stealing that. But a lot of what the Fed is probably admitting is we're just going to have to deal with a little bit of excess inflation for now, because at the other end of the scale, deflation is way, 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 way worse.
Yes.
Yeah. If we start having that crash, our current consumer economy is not equipped or ready for deflation. Now, at some point, we're going to have to pay our credit card down a little bit, but that's a conversation for another day. All right. Our next article, so speaking of you savvy investors, regular listeners may have noticed that we do not discuss private credit much on this show, but the topic has become kind of, the topic du jour of the investing world, and I thought I'd have an opportunity with somebody that knows it better than I do to address it on the show. In fact, not only just you, John Luke Tyner, but Aptus Capital Advisors' own blog page has some information on it. You all have a recent blog post titled 5 Reasons Retail Should Be Wary of Private Credit, Especially Retirement Plans. Now, according to the article, private credit, I found this fascinating, private credit recently surpassed the entire market for listed high yield corporate bonds, meaning that there's more money in private credit right now than there are in what most people would refer to as junk bonds. Is that accurate?
Yes.
That's crazy. $1.7 trillion in private credit. Wow. And while the yield looks great, I've sat through these presentations. I'm going to tell you right now, folks, it's really compelling. The yield looks great. The line on the chart, it's so silky smooth. The marketing is so persuasive. These guys are really good. They're almost like the fixed index annuity guys. It brings out the best salesmen in the industry.
That's a good analogy.
They're just like they flock to this
but
part.
It's a little more sexy than the
it's a little
annuities.
more sexy than annuities. But there's more to the story. So you care to expand. Why should retail investors be wary of private credit?
Well, I think there are a number of things to think about when it comes to private credit and investing and how it fits in portfolios. The key sales pitch that they talk about is the lack of volatility, like you talked about, the silky smooth line. And while that might be true when I print out a fact sheet, if you think about it from an actual retail investor's experience, it's not true because they aren't marking to market the actual value of the properties or the loans or whatever that they're invested in, because they have these cool things called lockups where you can't get your money out. And so I think a lot of it really sounds great on paper, and then a year from now when you need your money back and you can't get it, or you can only get 5% of the investment you put in, and you have to do 5% every quarter until you're out, which is going to take forever, that it creates an illiquidity backdrop for investors that most people can't stomach. The nice thing about public markets is that you have constant access to your capital.
Well, so you went a pretty heavy word there called mark to market, right? So just in kind of general terms, when you're buying or selling a publicly traded company or an ETF or a mutual fund or whatever it may be, especially NASDAQ or New York Stock Exchange, there's thousands of potentially millions of sellers and buyers on each side of the equation, right?
Every day.
Every day.
Maybe every minute.
Every second, right? However, when you're talking about illiquid, specialized, much more narrow market, narrow buyer and seller markets like private credit, or we've talked about the Big Short when they were doing those options on the CDOs, there was only a very small market, which means that the pricing is controlled by a very small group of individuals, which means that not that they would do this intentionally, but they can smooth out that volatility without really breaking it. They can get into the gray area without getting in and breaking any rules. Fair way to put it?
Yeah. So I think two things to add is they can price it at whatever they want to if they don't have to sell it. And then the second analogy is if you think about, you look at your stock account and you can see the prices move day in, day out, second by second.
Right.
That's liquidity, right? You can transact. It might not be the price you want to transact at, but you can. And then the other is think about your house. Well, you can look on Zillow and see, my house is worth $1 million. And then, in a year from now, it's worth 1.1. Well, it's only worth that on paper after you transact with it. Not only is there, potentially a bid-ask spread between what someone's willing to pay for it, but also there's commissions you have to pay, real estate, taxes, fees, etc. And so I think a lot of that stuff is underlooked when it comes to the typical private equity or private credit type of pitch, is that there's a lot of things going on underneath the hood to make it work. And then the probably most important to long-term compounding is the fees that you're paying for that. And so if they give you an 8% yield, but after you add up all of the expenses, it's 300 basis points or 3%.
Right.
Well, are you really better off just buying a treasury today than putting your money, locking it up into something you can't get out? It's certainly not guaranteed, right? You're betting on them actually achieving success. And so we typically steer clients away from private credit, private equity type of investments because there's just kind of a suitability piece of the equation that most people don't think about.
Yeah, they got to go in those things eyes wide open, right?
Yeah, and your blue blood type of client that we typically deal with, call it your $500,000 to $4 million client, somewhere in that. there's really not a need to allocate to it within their portfolio. If you have $100 million, then yeah, sure, maybe you want some exposure,
you're trying to
not to,
right? Yeah.
You want some diversification. But really, I'd say a lot of that diversification within private credit is fake because the stuff doesn't price.
Very good. All right, well, listeners, whether you got 500,000, 4 million, or 100 million, just give us a call today. That was a good one. Now, listeners, if you want to, if you like what you've heard and you want to discuss your own personal retirement dreams and goals, give us a call, 251-327-2124. Or again, find us on the website, gulfcoastfa.com. FA is in financial advisor. Blue button in the upper right-hand corner, click it. That will put something on my calendar. We can do phone calls, we can do Zooms, but I'd really like to meet you in person. I think you'd rather meet us in person too. We got 3 office locations, downtown Fairhope. Then we got an office in Orange Beach, and we got an office in Mobile, near the intersection of Dolphin Street and I-65. Make sure you reach out to us. All right, folks, coming up next, Josh's crystal ball and big mouth would have been some of my predictions. What's been some of John Luke's predictions? Were we right? Were we wrong? What do we think is going to affect investors in the near future, maybe even the distant future? We talk about all these things and poke a little fun at our big mouths. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Welcome back. Your host, Josh Knoll here, joined by returning guest host, John Luke Tyner of Aptus Capital Advisors. All right, so regular listeners know I'm opinionated. I got strong opinions at times. I would say a radio show host that isn't probably would not be very interesting to listen to. And John Luke and I are paid in our respective professions to offer professional guidance and opinions to our clients. Otherwise, if we don't say anything intelligent, just replace us with AI, which kind of feels that way anyway. But anyway, I like making predictions. Sometimes I hit the bullseye. Sometimes I swing and miss. We're going to look at some predictions that we made, and we're going to see which is John Luke or me, which of us is going to eat a little crow today. Let's find out. Get at it with Josh's crystal ball and big mouth. All right, John Luke, here's a fun one. Did 2025 go fast or what?
Man, it has.
It's crazy. And it's funny, it seems yesterday you were on the show for the first time, and it also seems like it was 5 years ago. Time it just blurs. But back in April of this year, well over 20 episodes ago, you came on and I asked you to make a prediction as to where the S&P 500 index would end at the end of 2025 this year. Now, of course, the year's not over yet, but I'm probably not going to get you back on the show until 2026. So I wanted to go ahead and see how these predictions played out. I'm going to set the table. When we recorded that episode, the stock market was in a general sell-off related to investors' reaction to President Trump's Liberation Day, where basically he announced tariffs on the entire world. At the time of that recording, the S&P 500 was hovering around 5,400, right? Remember that?
Yep.
As of this recording, it's hovering around 6,850, which, I mean, easy math, that's a substantial increase. I didn't do the math, but that's got to be...
It's like 37% since the lows.
Oh, man. So if you'd either bought in or just held tight, you would have had a substantial increase nonetheless into an S&P 500 index fund. Anyway, back to the point. I hope J.D. Gardner, you're the guy you work with, is listening, because if our prediction race was called today, he won it in a landslide. I predicted, again, back when the S&P was at 5,400, I predicted that in December 2025, the S&P would be 6,500. JD predicted 6,800, which it's 6,850 right now. And you, John Luke Tyner, predicted what?
7,000?
6,100. Good try. 6,100. Now, so you came off as really bearish, which you're not. But if you also, to be fair to you, that looks like a bearish prediction. But you also told in that episode, because I went back and re-listened, you said the investors should not bet against the U.S. consumer, and that these type of market sell-offs back in April are never as bad as you think. With all that said, what do you have to say about your 2025 prediction, and what say you about 2026?
Well, I don't know who listened to me.
They would have been like, oh my gosh, I got to go to cash.
I didn't even stick to my own mantra of the self-inflicted drawdowns. I going back to that point, there was a lot of fear in markets. You were seeing things unwind. And it's a great reminder of that volatility is kind of the toll that you pay for the long-term compounding impacts of being invested in the market. And it was a great opportunity to get money to work. I guess the one thing I will say, like, not claiming victory, but at least it was higher than where we were at the time. So I wasn't recommending to sell.
You weren't trying to sell an annuity and say, oh, it's going to be at 4,000 by the end of the year. Get out now, right?
Yes.
Or sell gold or some nonsense. Anyway, pardon. Keep going.
Yeah, so for 2026...
What's your prediction? We're going to write it down. Write it down, listeners.
Now I know I'm being recorded. And I'll come back to this.
Speaking of, this is just a fun prediction.
Yes.
Again, any of you regulators listen, we have no idea. We're just having some fun with the crystal.
This is a pure guess.
Yeah, I say I have a crystal ball as a joke of the fact that I don't have a crystal ball, neither does anyone else. So where do you think we're going to be?
Yeah, so on our point about the One Big Beautiful Bill and the consumer impact that we talked about, that $150 billion of refunds, basically, that's going to lead to rough estimates of $20 additional of S&P earnings. So, you're talking about like 7 or 8% of the expected S&P earnings just coming from that alone, which is certainly not bearish. I think that the market can continue to maintain a higher multiple than what we've averaged because the confines, the breakdown of the companies in the index are much different, much more profitable, growing much faster, have much less hard expensive, like when you think about the S&P 500 of 30 or 40 years ago,
right? Like
the profit margin was like 7 or 8%,
right?
Because they had to spend so much money every year to refurbish the business to grow for the next.
Agreed.
Well, now the whole index to an extent is based on intangible assets. So that's kind of innovation and past investments in technology. And so with that, there's much less cost to keep that running and keep the profitability going.
All right.
And so I think
where'd you land?
7,700.
Okay. All right. So I wrote it down so I didn't cheat you. I wrote 7,750.
Okay.
So now JD's going to come on in a couple weeks and probably say it's going to be 8,900 or something.
He likes to go up by 1,000 increments.
Yes.
So it'll be 8,000.
Well, we'll find out. All right, listeners. Last time, if you all want to reach out and have a conversation with us, give us a call, 251-327-2124, or visit the website, gulfcoastfa.com. That is our show for the week. I want to give a huge thank you to my guest co-host, John Luke Tyner. Thank you, buddy. You did a great job again.
Thank you, Josh.
Yes. Thank you to our show sponsor, that's Providence Partners and Mr. Jay Stubbs. Thank you to our awesome radio station, that is FM Talk 106.5 out of Mobile. What up, Celeste? Many thanks to the provider of our show music, that's local band Sloth Racer. What up, Franklin? Huge thank you to the show producer, that is my son, Peyton Null, War Eagle. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.